Do we have any documents up to take notes on, or is this more of just
All right. Can you see my screen?
I can.
All right, where I have the Word document scrolling?
Yes. Yes, sir.
Okay. So that document has been posted to this announcement. Okay. And it's right here. It's also in the exam study guide folder. This folder here down here, Spring 2020. All right.
So would it be in my best interest to go ahead and open that right now? So, or is that just something to use?
I think it's a good idea to open it now.
Right.
Welcome, Travis. All right. So yeah, under the exam study guides, open that document. And I'm going to go through parts of that document now. All right. First off, the exam information, which is in that document. There are 2 charts on the final exam. We're going to review each of them today. There's one essay on the efficient markets hypothesis. I'll go through that today. And then another essay question, and there's really 3 different questions. All 3 of them are in this document. It basically just varies by the age of the client and some of their circumstances. And I'll explain that to you. For the exam itself, if we go to Blackboard here, and we go to the announcements page, all right, way down here, the exam, same things, date and time of the final exam. One is Monday, May 11th. The other is Friday, May 15th. And see class preparation assignments. So if you go over to class preparation assignments, at the very top, you can click on choose your exam date. All right, click that on, just click on that folder and begin, and you can choose question. Basically, there's one question: what date do you want to use? And there are 2 other options. One of them, I prefer to take the exam in 2174, or you prefer to have me take the exam for you, and those are not correct answers. So choose A or B, and I will send out a reminder of that over the weekend for anybody who has not chosen their exam date. And that's going to let me know who to send the exam to. I'll be doing emails of the exam on Monday morning, 10:28 a.m. I'll be sending out emails to anybody who's signed up for the exam with the actual exam itself. All right. So let's get into the exam a little bit. All right. This is basically the format. There are, that's 290, 346 points in this exam. Each chart is worth 40 points, 210 points for this letter to a client that you write, and 56 points for the efficient markets hypothesis. All right. You'll be downloading that file probably from the email that I send you, and you should save it, type your answers. You could print the document out and write your answers, but then you need a scanner of some type, or so you can upload it to Blackboard as a PDF file. But if you just work on it and type your answers, which is fine, you can just upload it as a Word document, all right, at the end of the exam period. It's open book, open note, but please don't communicate with anybody else during the exam, and don't just copy answers from the web or other documents. I am going to check things for plagiarism, so I'd like the answers to be in your own words. All right. You probably won't need any of these terms, although certainly the terms are there. But let me come back to the efficient markets hypothesis question and go to this question on tax efficient asset placement. This is the actual question that's going to be seen, but the amounts will vary. There's going to be so much in the traditional IRA, a tax deferred account, so much in a Roth account, which is gross tax free, and so much in the taxable account. These are the asset classes that will be shown on this chart. These are the rates of return that will be shown in the portfolio return. The asset allocation will change, so how much is in each asset class will change. And of course, the totals down here will match the totals up here that's in each account. That's just as a reminder for you. So let me give you an example, all right? Spider-Man has 3 accounts. I should have said Spider-Woman, but it's 700,000 in this case in her traditional IRA account, 100,000 in a Roth, or 200,000. I actually changed these numbers and I made it 500,000, 100,000, and 400,000 because we're recording this video and the video I did this morning did 700, 100, 200. I changed the asset allocation here as well from the morning. So everything adds up to 100% here. So we have to figure out where to put things. And I am going to just make this a little bit smaller so we can kind of see everything on one page. I hope you can see the screen here. All right. Let's go through the steps. The first step is we want to put the foreign stocks in the taxable account so we can get those foreign tax credits. Often those tax credits are equal to a rate of return of maybe 0.5%. We don't want to lose that tax benefit. If we put those into a traditional IRA or a 401k account or a Roth account, we're going to lose those tax credits. We have 50,000 in the Foreign Developed Markets Fund and 150,000 in the Emerging Markets Fund. We want to put those in a taxable account. We have 400,000 that we can put in there. So we're just going to go ahead and put 50K and 150K here. All right. And that takes care of those. The next step we want to do is look at our fixed income investments. We want to put all of our fixed income in our traditional IRA or traditional 401k account. It grows tax deferred, but it doesn't get taxed until you take the money out, typically in retirement. We have 400,000 there. We have 500,000 we can put in that account. And I should change these numbers down here, 5, 1, and 4, okay? So we can put all 400,000 there. The next step is we want to put the asset class with the highest expected return in the Roth account. If we look down here, we've already used up these two. The highest expected return is the small cap value, no surprise there. 100,000, and we need 100,000, so we'll just put 100,000 there. And after that, we just need to figure out where the rest goes. Now, the fourth step is put your most tax-efficient stock fund in the taxable account. We have the taxable account here, 400,000 is in the account, but we only have filled it up with 200,000 of assets. Our most tax efficient is the one with the lowest portfolio turnover rate. All right, so we can take all 100,000 here and put it here, 100K. And then,
hey, Dr. Rhoades, can you go over what you just did? I'm sorry.
Yep.
Okay, thank you.
So after we do the foreign and after we do the fixed income and after we do the highest performing asset class to the Roth, the fourth step is figure out of what's left, what is the most tax efficient asset class? The most tax efficient asset class is the one that doesn't do a lot of trading, so it has a lesser portfolio turnover rate. We only had 2 asset classes left here, and the one with the lower turnover rate is, in fact, the large cap fund. So we can put all 100,000 over there. We still haven't filled it up, okay? And then we're left with this asset class, and there's only one place to put that. We need to divide it up, 100K in each one. So basically, you just fill out the chart after that. Any questions on that?
So your foreign is going in your taxable, and your most valuable, your small cap value, obviously, is going in your Roth. And then after that, you're splitting up your what's most tax efficient, which is your large cap. No, you put all of your large cap in taxable.
Yep. There was
Because
room for it. There was room for it in this case. Okay.
Okay. And then what's left is your value, right?
Yeah, you just have to divide that up. Now, the second step you missed, which was put your bond funds in the IRA account. The traditional IRA or traditional 401k, it grows tax deferred. So you're not paying tax on all that interest every year. It's just growing on a tax deferred basis until you start taking it out in retirement. That's when you pay the tax on it. Bonds generate a lot of interest income. You don't want to have to pay a lot of interest. You don't want to have to pay a lot of taxes on that. So that's actually the second step of the 5 steps. Let's do this again with a different chart, okay? Here we go, it's a different one, all right? Different percentages here. Down the left, 300,000 in the traditional IRA account, 600,000 in the Roth, and 100,000 in the taxable account. Step number 1, we want to put into the taxable account foreign stock funds. Well, we have 2 foreign stock funds here. We have 100,000 here. We have 100,000 here. We only need 100,000 here. So we could just say, hey, let's split those, 50K each, okay? That gives us our tax credits for each of those asset classes. All right, we haven't used them up completely. The second step is, where do we put our bond fund? We got 400,000 of that. We want to put it in the traditional IRA account, but we only need 300,000 there. So we put 300K there. Well, guess what? We filled up 2 rows. We filled up this row, 100,000. We filled up this row, 300,000. Guess where everything else has got to go? What's left? 200K here, 100K here, 100K here, 50K here, because we have a total of 100. We want to use 50 before. 50K here, and all of this should add up to 600,000 if I did it correctly. Oh, we need 100,000 here because we had 400,000 here. We do want to use 300,000. So now that adds up to 600,000. So sometimes the charts, you don't have to go through all 5 steps. But in this prior chart, we had to go through all 5 steps. So that was a pretty good chart to do. I would encourage you to look at this morning's video, which has been uploaded to YouTube. There are 2 different examples there, and that will help you out as well. Questions on that before I go on? All right. Let's go back to the efficient markets hypothesis. All right, we have the question here. Explain in your own words the 3 versions of the efficient markets hypothesis. Which version of the efficient markets hypothesis do academics believe to be most acceptable? And these are basically my answers to that. All right. I kind of outlined it here. I'll just take the color out. And let me just review it and talk you through it. The first form of the efficient markets hypothesis is called the weak form. Basically, it says that past prices, just the past price information, which shows up if you could take all those past prices and chart them out, okay? Those past prices cannot be used to predict future returns. People who do that type of analysis are called technical analysts. They do technical analysis. They're also called chartists. They do charting. And pretty much for 20 years now, the academic evidence has been pretty conclusive that charting makes no sense whatsoever. They might find 200 or 300 different patterns there in terms of all the price movements and stuff, but none of those patterns means anything. There's nothing that supports it from the standpoint, this is an academically valid pattern, with one exception. And that exception is momentum, which we studied. It's a factor, okay? So pretty much the weak form of the efficient markets hypothesis is very strongly believed in the academic community. All right? Basically, anybody, and I still see ads for charting. I still see webinars for charting. I will still read articles in Wall Street Journal and Bloomberg. This technical analyst is saying this about what's happening in the market. And I'm like, I can't believe that the media is even reporting on this stuff. So, because it's so bad. Then we have the semi-strong form of the efficient markets hypothesis. Now, the semi-strong form includes the weak form, but it also goes further and says that all publicly available information about a company or a stock is reflected in that stock price almost immediately. So if a company comes out and projects that their earnings for the next quarter are going to be so much, that information, the price adjusts to that very quickly. If there's any type of announcement that concerns that company issued by the company itself, it could be, we're doing a merger, we are spinning off a division, we just signed a big contract, some press release or something like that. It could be somebody else writing an article about the company. We can't believe what Walmart's doing. Then they got a lot of employees that are exposing themselves to a lot of liability because of COVID-19. An article comes out and people think, uh-oh, Walmart might be sued. That's going to hurt their profits. That information is incorporated into prices almost immediately because of all these thousands of people using that information. We actually have a course in which you take 400 different data points from financial statements, and you use those data points to try to predict what the future of the stock will be. That's called quantitative analysis. We actually have a course on that here at WKU. All right. The semi-strong form says you can't use quantitative analysis or what's called fundamental analysis, looking at all these data and other news that might come out and try to predict whether this stock is going to outperform another. In other words, stock picking is refuted by the semi-strong form. There's a lot of evidence to back that up. I would say in terms of the evidence that high cost and active management, where you're paying a mutual fund manager like 1% a year or even 0.5% a year to go out and pick stocks, that basically the additional fees are likely to take away any added return that mutual fund manager is going to have, at least on average. Right? The longer the time period, the more likely it is that active management will underperform passive management. Kind of the reason for that is it's a zero-sum game. Anybody who outperforms the market, somebody's got to underperform the market. That's the zero-sum game. But the other thing you have to do is subtract fees and costs. That means there's going to be more losers than there are winners. All right. I would not have the conclusion personally that low-cost active management is a fool's game. But we don't have a lot of low-cost active managers out there, real low cost compared to the real low-cost index funds that are out there right now. I don't think there's just enough academic evidence to support that conclusion. But generally speaking, the semi-strong form of the efficient markets hypothesis, which includes the weak form, is strongly supported by academic evidence, and most investment advisors, I'd say at least half, believe in it, maybe more than half. Right? If you want to start an argument at any investment conference full of investment advisors, just yell, active versus passive, and believe me, you'll start a big argument. All right. So the strong form of the efficient markets hypothesis includes both the semi-strong forms and the weak forms, but it goes further. And it says that private information that has not been publicly disclosed about a company, also is reflected in the price of the stock. Well, that's not always the case. And we know that because the CEO of a company, the chief financial officer, other officers, directors of the company, often have access to this internal information. They might say, gee, there's an announcement that's going to come out next month or next week when we issue our earnings reports. And we know what those earnings reports are going to be. And we know that the stock price, once this earnings report is released, the stock price will go up or down. So they might trade on that information ahead of when that news is released. That trading is legal, by the way, unless they're in the process, unless they are issuing new stock at that time. There's some restrictions on that when you're issuing new stock. But most companies that have been a while are not issuing new stock, and therefore they are allowed to basically, corporate officers and directors are allowed to trade on the information inside that company. But they do have to post that information, publicly traded companies, officers and directors have to notify, submit a notice to the SEC within 5 days of when they trade, telling whether they bought or sold, how much they bought or sold, what the price was. So that information eventually gets into public view. There are other type of insider trading, like for example, if your neighbor was an officer of a publicly traded company and told you, oh, wow, our biotech firm, we just found the cure for COVID-19, and we're going to announce that next week. And that's really going to drive the price of the stock up. And you take that information and you trade on it. You're not an insider, but you're trading on that inside information. That is called insider trading, and that is illegal. You cannot do that. You cannot let your clients do that, trade on inside information. But because we know that insider trading takes place illegally and insider trading takes place legally, and we can actually look at the data there and say, yeah, those people are actually outperforming the market over time based on the information that they have. Most academics will not support the strong form of the efficient markets hypothesis. All right? Any questions on that? Okay. So let's go on to the next question down here. We have a fact situation. We have 3 of these situations. In the morning session, review session, I went through this one. So I'm going to go and do the last one. One of these 3 questions will be on your exam. Now we have an exam both on Monday and Friday. So one of the exams, I'm going to give one question. The other exam, I'm going to give another. I might even break it up and have some people on Monday get one version and some another, right? The facts are pretty similar, but they're not all the same. So in this case, your clients are Hawk and Nat, also known as Natasha of Avengers fame. They're both 58 years old. Married, they have a child who, despite starting Western Kentucky University as a child prodigy at age 16, spent 7 years there, fortunately has a full-time job with a government agency not to be named, and the child's job is believed to be quite secure. So we got a married couple. They've done quite well for themselves. They possess a home worth $500,000, traditional 401k accounts worth a combined $2 million, Roth accounts worth $1 million. They must have started saving in Roth pretty early. They don't own cars. Instead, they take Ubers. All right. And this is in the future, so far less expensive then. They have no debts. They have a cash reserve equal to 6 months of their expenditures. So all this money, $2 million and $1 million, can be invested essentially. All right. The only extraordinary expense they possess is a lot of new clothes purchases for Hawk for some reason. They desire to withdraw each year 3.5% from their investment portfolio, which is a modest amount. They desire the portfolio to grow at a rate equal to inflation, which is anticipated to be low at 2% a year. And the total fees and cost relating to an investment, including investment advisory fees, only 1%. Therefore, they need a portfolio that will generate gross 6.5% a year. Using the chart below, establish a strategic asset allocation for the client, and then explain it. Why did you choose it? Why did you include or not include certain asset classes? And did you use the principles of the Larry portfolio or not in this portfolio? So basically, let's come down to the chart. I'm looking for some things in this chart. The chart is here. But first off, I'm looking for an equity allocation that's in the correct percentage of the total. There's no single right answer, but you would think that a younger person would probably have an equity allocation of 80, 90, even 100% equities. An older person close to retirement might be 50, 60, 70% equities. And somebody who's somewhere in between would be somewhere in between. All right? There's no one right answer there. Of the equity allocation, 30 to 50% of that should be allocated to foreign equities. All right? And then I want the thresholds for rebalancing to be correct and adding up all the contributions to portfolio returns to be correct. So we have the Hawk and Natasha here, 58 years old, and we have all of these asset classes. I wanted to point out a couple of things because this is a little different from the document you downloaded. I had two of these asset class categories, the same asset category, so I had to take one out, and I left the 12% in for foreign emerging market stock fund. I went ahead and assigned an expected asset class return to hedge funds and commodities. Right? So those are the only changes. So you have all of these asset classes, right? Including real estate investment trust, hedge funds, commodities, corporate bond funds with a moderate duration, corporate high yield bond funds. So we have some junk bonds in here. We have U.S. Treasury long-term bonds with a duration of 18 years for that fund, and U.S. Treasury short-term bonds. We have all of the expected returns of each asset class. That's the average expected return over the next 15 years, all right, is reflected there. And we need to build this portfolio. Well, one of the things you ought to be thinking of is, does this client need real estate in their portfolio? What do you think? Mark says no. I agree. No, they've got 500,000 of real estate. Now, if somebody put 10% of real estate there, I would be okay with me, as long as they explain why. Right? But personally, I would not do that because they have 500,000 of real estate. That is 1/7 of their net worth already. All right. So now the question is, should we put any money in hedge funds? Yes or no? The answer would be no. Why? We want to explain this in our essay. We want to explain we're not putting hedge funds in there for several reasons. One is they are risky. They are not regulated very well. They are not inspected. We don't know if the assets are really there. It is very difficult to get that data. All right. The data on return show that hedge funds over time, over long periods of time, actually underperform the S&P 500 index on average. That doesn't mean that there aren't hedge funds that are going to outperform, because there will be, but we don't really know how to select which ones are going to outperform. We have the same problem with actively managed funds and generally. I can tell you that hedge funds did not go down collectively. I've seen some articles. I don't know how good the data is, but during the month of March, when the stock market went way down, about 32%, there were articles out there saying hedge funds only went down 20%. There are some hedge funds that actually hedge, use options to basically hedge the market. But over the long term, hedge funds basically don't outperform the S&P 500 index, and they're risky because sometimes the managers of those funds take off with the money. The other big reason is the fees, 2 and 20. 2% is a management fee every year, plus 20% of the profits. The reason they probably underperform the S&P 500 index, even if they're really good managers, is they really have to be great managers after charging those fees for the investor to get a return higher than the S&P 500 index. So you need to explain the 2 and 20 fees. Why not commodities? All right. Well, commodities generally have performed at about the rate of inflation, but with a very high degree of volatility. Now, if somebody were to put commodities in here, and they would put in their explanation, oil prices and natural gas prices are at all-time lows right now. Right? Other commodities have taken hits. And just from the standpoint of valuation, if we think that oil prices might go high at some point in the future, commodities could be a good bet. Right? I probably accept an allocation of 5 or 10% to commodities at this point. The last 15 years have been very unfavorable to commodities.
Dr. Rhoades,
yeah.
would you want to, if you decided to put some money in the commodities, like, you know, they're saying it's the all-time balance after like a couple months once the commodities go up?
I think whatever you're doing as a strategic asset allocation would need to be maintained. So what you're talking about is, oh, we're going to take a little bit of a bet here. And if we win that bet, we're going to change our strategic asset allocation. That's called market timing, and I'm not a big fan of it. Okay?
Gotcha.
Because you've got two 58-year-olds. They're about ready to retire. So what in the hell are you gambling with their money for? Right?
Yeah, that makes sense. All
right. So to me, but if somebody were to put that and explain why a small allocation to commodities, I'd award points for that. So let's go down to these corporate bond funds. You know what? Here in the COVID-19 crisis in March, all corporate bond funds went down in value. Even high investment grade bonds, short-term in duration, even though interest rates went down, people were afraid of risk. And the risk of corporate bonds is the company files bankruptcy. Today, 3 publicly traded companies filed bankruptcy, Crew and 2 others, I believe. So not 100% sure what happened with each of those companies, but all of them I think were retailers or close to it, and they were probably doing that anyway. But the bondholders are going to take over the company, but they're going to turn their bond into equity in all 3 of those cases, but then they're not going to get the value of those bonds. They've lost money. The bondholders have lost money. So just when we want bonds to hold up our portfolio, when the market goes way down, like it's done in March, like it did back in 2008, 2009, corporate bonds did not do the trick. And that's a good reason. Gold's Gym, yes, was the one who filed bankruptcy. Yeah. So, and they filed Chapter 11, so they'll probably be open again as they restructure and the like. So we need to go with U.S. Treasuries. All right. If you're going to own a bond fund, you're not going to get rewarded a lot for that extra risk. You're not going to want to own a corporate bond fund exactly when you need it in a Great Depression. And by the way, we could have a Great Depression. We've had a recession, a huge recession right now that we're in, and this could easily become a Great Depression. I don't know for sure because a lot of it depends on what's going to happen with COVID-19 and the medical treatments that either come out or don't come out, as well as some public policy decisions. So we need to go with U.S. Treasuries. But we're in a low interest rate environment, and if you go out and buy a U.S. Treasury long-term bond right now, you're lucky to get, I think it's 1.7% interest on a 30-year bond or something like that. A short-term U.S. Treasury bond is only getting like 0.4% or something. But over a 15-year period of time, we would expect to get a higher return on each of those. The problem with U.S. long-term bonds is if interest rates go up, if you have a duration of 18 years, if interest rates go up by 2% for long-term bonds, and remember, they fell by 2% just in the last couple of months, right? So they could easily go back up 2%. You're going to have about a 36% drop in the value of that bond fund. So you want to go with short-term U.S. Treasuries. And somehow you're going to have to explain that in this essay that you're doing. So we have a 58-year-old couple. We might say, you know what, we want to be about a 60-40 allocation. No real estate here, none of these other asset classes. So we just put 0 in each of these. 40% short-term bonds, and we got 60% to put in the stock market. Now we have here large cap balanced US stocks, small cap value stocks with the profitability factor, developed markets large cap balanced stock fund, developed markets using the size, value, and profitability factors, so basically small cap value with profitability again, emerging markets with small cap value and profitability. So if you look here, you have kind of two choices. Do you want to have a little bit more conservative portfolio where you put large cap stocks in there, and during Great Depressions, large cap stocks don't go down as far? Or do you want to do the Larry portfolio? The Larry portfolio would basically say use small cap value, both US, foreign developed markets, and also foreign emerging markets. And depending on what your answer is, you might be able to adjust your allocation to fixed income. I'm going to do the Larry portfolio. I want to put about 30% US small cap value. I'm going to do about, we'll say 10% foreign developed markets, and I'm going to say 10% emerging markets, and I'm going to change this down here to 50% and see what happens. Okay. I'm not going to put anything in large cap stocks, both foreign developed. This should be 10, and this should be 0 up here. Developed markets, large cap. All right. So I've got 50% in stocks, all small cap value, spread out between here. I've got less than 50% of my total allocation to equities to foreign stocks. I have 20 of the 50% total, that's 40%. That's somewhere between 30% and 50% of all my equity allocation is in foreign stocks. That's a target I'm looking for in this exam. So now I want to figure out what is the upper and lower limits for rebalancing. The way of doing that, you might want to just go up here and at the start of your exam and say 0.8 or times 1.2. All right, just write that in at the top and go here. 30 times 0.8 is 24%. 30 times 1.2 is 36. So that's 30 plus or minus 6%. We come down here, 8% and 12%. Whenever you see 10%, you can do that. 8 and 12. And then we come down to 50%. And here's where we have a choice. You can do plus times 0.8. That would end up with 40 and 60. Or you could do what Larry Rhoades taught me many years ago and go plus or minus 5% from whatever your target is. Because you may not want a portfolio, especially when you're 50-50, that could either be 40% or 41% or 59%. That's a tremendously different type of portfolio in terms of risk. But if you go plus or minus 5% for your fixed income allocation, you're going to basically force rebalancing more often, and you're not going to stray too much from the risk threshold you want for that portfolio. So either one of those approaches is fine. And now we want to say we want to figure out the expected contribution to the portfolio returns. 30 times 12, so 0.3 times 12% is equal to 3.6. Of course, you can use your calculator here. 0.1 times 1 is 1, or 0.1 times 10 is 1. 0.1 times 12 is 1.2. And then we're going to come down to here. 50% times 2, or 0.5 times 2 is 1. So here's the question. Are we going to reach 6.5%? So we have 3.6, 4.6, 4.8, 5.8, 6.8%. We want it 6.5 or above. When we go back here and to our facts, we wanted to get a portfolio that had a minimum of 6.5% per year. So we are able to have a nice conservative portfolio with this using basically the Larry portfolio. And you would explain why we're using the Larry portfolio in this way. It comes all from that CPA that we did that explored the book, how to reduce the risk of black swans. Okay, so you would do that. You would explain that. You would explain each of the factors. Now, in this case, you could say something like, there is a 80% or greater probability that over any 20-year period of time, small cap stocks will outperform large cap stocks, value stocks will outperform growth stocks, and high profitability stocks will outperform low profitability stocks. So instead of having 3 different paragraphs, you can use 1 paragraph. But then you got to explain, what is a value, what is growth, what does high profitability mean, what does low profitability mean, what is small cap, large cap, small cap, 2 billion or less in stocks, publicly traded in the US, 10 billion or above for large cap. So you have to explain that, those factors as well. If you have time, you want to go in and explain the reasons behind that. What are the reasons behind the value factor, the size factor? Those are both behavioral finance reasons, and those are also risk-based reasons. And for the profitability factor, there's a different type of explanation for that. You might also want to explain the market factor or the equity factor. Why do stocks outperform bonds? Because there's more risk there. Quantify what that risk is. In terms of explaining that risk and return are related. Right? If you want to go a little bit further, you could say, with a portfolio like this, we'd like you to also see a rebalancing bonus of some type. Because we are forcing ourselves with this rebalancing process to buy low and sell high. That rebalancing might be, depending on how volatile the stock markets are, could average over a 10 or 15-year period anywhere from 0.2% to as much as 0.9% a year. And in a portfolio like this, we have closer to a 50-50 allocation. It's actually going to be more towards the high side if you have a volatile market. So you'd explain all that in an essay. And of course, I'll give you some room here. All right. This is the chart we did, I believe, or just another chart. I guess I did it for somebody else. That was the one I did this morning, and that was example A. So I'll just pause it here so people can look at it. This was the younger couple or the young individual, single, 20% allocation to fixed income investments. Real estate, 20%, did not own any real estate, living in an apartment. And then 60% allocated to stocks, with half of that being foreign stocks, maximum of 50% you want to put in foreign stocks. You might explain that in the publicly traded markets of the world, about half of the value of all publicly traded companies are companies based in the United States. About half are foreign, developed markets and emerging markets. If you have time, you might want to explain the difference between developed markets and emerging markets. You might want to explain that it's okay to have a home bias. If this portfolio was set up as a home bias, the prior one we did have a bit of a home bias. This is only 20% foreign as opposed to 30% US. You might say it's okay to have a home bias. People feel more comfortable with what they're familiar with, for one thing. The other is, in terms of the US has extraordinary levels of entrepreneurship, innovation, compared to a lot of other countries. As a result, the economy of the U.S. has outpaced the economy of Western Europe. There's also some demographic things that go on with Western Europe and Japan. Their populations are actually in a decline. The U.S. has a low growth rate at present. The population is not growing as fast as it used to, but there's still slow population growth. Hopefully at some point we'll have more immigration and we'll have more population growth, but that's not happening right now. Emerging markets population growth is still happening. Plus, emerging markets, the economies are moving from agricultural production and exporting agricultural products and commodities to being a more service-based economy, more manufacturing, a more modern economy. And as they do that, more and more people are getting jobs that pay well, which is lifting the gross domestic product. Basically, everybody's getting paid more. It lifts the gross domestic product of the entire country. It turns into more of a consumer-based economy as opposed to an export-based economy. So you're going to get growth in the economy, and if you own stocks that are heavily invested in that country, you're likely to get superior returns there as well. Wow, what time is it? All right, we got 13 minutes. Questions?
So you were talking about this, but I have a little bit of confusion. Will one of the three scenarios that we are currently looking at, the 58, 35, and 22-year-olds, will one of those be the one on the exam, or will it be something similar to those but different?
Nope, it will be one of those.
Okay.
Not a single word will be changed. All right.
All right.
All right. So yeah, in theory, you could actually pre-write your exam answer and then just copy and paste over. You could do that.
Well, I guess you'd have to write 3 exam answers, right?
Well, you know, when you explain all those factors and you explain other things that we went through, your differences are going to be whether you're including real estate in a portfolio and how much fixed income. So those are going to be the key differences. When you get to explaining a lot of the asset classes and why they're included or not included and explaining the factors, that explanation is all the same.
Yeah,
So,
that makes sense. Okay.
So a lot of what you could do would just be repeated. I mean, this exam is, I think, a fairly easy one if people prepare for it. All right. I do want it in your own words. I don't want you to copy directly out of. I put together all the CPA answers into one document here. They're towards the end here. So here's like all the answers to CPA 1. Just don't copy this text. Put it in your own words. Use your own style. Okay. I am going to check these things for plagiarism. So I don't want like one person to explain you copy something directly from somebody else who's preparing for the exam. Put it in your own words. Now the Larry portfolio, good question, Mark. All right. Basically, the original Larry portfolio said for a retiree, you could have 35% equities and 65% fixed income or something like that. And you could take 35% and just put it in small cap value, both US and foreign international. And at the time, because there wasn't emerging markets, small cap value, basically an emerging markets fund. Now there is emerging market small cap value funds out there. All right. So basically what Larry said was, we're going to combine the market factor, the equity factor, with these other factors. These other factors have slightly different correlations. So if, for example, small cap stocks are not doing well, which has been the case even this year, the profitability factor has been doing well this year. So we're going to pick up some extra return. What we're going to do is basically boost these equity returns by using multi-factor investing. And because we've done that for that part of the portfolio, we don't need as much exposure to equities. we can reduce the allocation to stock mutual funds. We're going to have a higher rate of return for that part of the portfolio. And we're going to increase our fixed income allocation to some percentage. And because of that, we're going to have a much safer portfolio if there is a Great Depression and stocks fall by 80 or 90%. Okay? There's a lot of evidence to support this. I have done the data myself. I wrote a paper on this before Larry actually wrote his book. I think it was back in 2006, I wrote a paper on using small cap value essentially to tilt your portfolio heavily that way. And then I examined the biggest drawdowns in the stock market in the 20th century, and including the 2001 to 2003 scenario. And basically showed how this portfolio would have worked better in every one of those 10 big drawdowns in the stock market. So basically it becomes a less volatile portfolio, a less up and down portfolio, which is very important for retirees, because if you're pulling money out of a portfolio and the stock market goes way down and then you rebalance, you're going to be pulling money out of both fixed income and stocks. So unless you do a different type of management of the portfolio, you're pulling money out when it's a low value. You really don't want to do that. That really hurts your long-term returns when you're pulling money out of a portfolio. Now, I would modify that Larry portfolio and say that Larry portfolio worked well when interest rates were high. With the fixed income allocation, you know, back then when the Larry portfolio came out, it was around 2010, 2011, you could get 5% on bonds, or I think it was the Larry portfolio came out before that. You get 5-6% return on bonds. That was your yield. You can't get that today. So you have to increase the equity allocation to get something like that. You can't go 35% equities when you expect very long-term low interest rates for a long period of time, or even if interest rates go up, bond values will fall. You have to stay short in terms of your maturities and duration. So you can apply the Larry portfolio to the young investors account. I could say that 22-year-old could easily have 100% allocation to equities. All right. What risks do they have? They don't have any dependents, right? Maybe they can move in with their parents if they lost their job or something. And I know that's probably a sore spot for some of you at this point. Sorry about that. But from a standpoint of risk, they could take on 100% equity risk. But do they really need to if they use the Larry portfolio principles? They're 80% into these 3 asset classes that are all small cap value. They can get the same rate of return as just owning the entire stock market, both foreign and U.S., and having 100% total stock market. They can get the same total return by having 80% small cap value spread out between those markets and 20% these very safe bonds. Right? So there's different ways of using the Larry portfolio's principles. I think it's sound, and it's especially sound right now. And the reason for that is right now today, if we were to look at the Shiller PE10 ratio, CAPE10, right? CAPE10, I believe, is somewhere around 23, 25, not sure exactly, all right? That is probably showing a little bit of overvaluation relative to historic norms. Large cap growth stocks right now remain significantly overvalued. Small cap value stocks, they are 30 to 40% undervalued, and it's not just me saying that. It is Larry Swedroe writing about that. It is Rob Arnett from Research Affiliates. It's others. But this is one of the biggest disparities we've ever seen between growth and value stocks and between large cap and small cap. So just looking forward, the expected returns over the next 15 years of small cap value are much greater than U.S. large cap stocks. Some of the other observations here is the expected returns, by the way, in emerging market stocks are also quite high. Part of that is because the US dollar is so strong right now relative to other currencies, especially emerging markets currencies. So a little bit different take on, there's more risk in both of those asset classes if there's a Great Depression, but there's a huge amount of potential reward. So just to share that with you as well. Other questions? You never ask an attorney a short question, you're going to get a long answer. You know that.
I've got one, Dr. Rhoades. It's not specifically about this, but something we were covering made me think of it.
Okay.
Did you see how there was the highest percentage of commercial real estate contracts that fell through?
Yeah.
So would that would this unparalleled situation actually make it a pretty good time to invest in REITs, even as the old couple? That's kind of what made me think of it, just because, when things go down, buy low. So what is that, as the financial planner part of you, what is that saying about REITs?
My clients that own REITs as part of their portfolio, and it's only a handful because that don't have other real estate as like their home, I have actually been buying the broad rebalancing to buy and add a little bit to their REITs portfolio because I'm following the strategic asset allocation and the discipline of rebalancing. Having said that, there's a lot of unknowns on commercial real estate. I have read a lot of articles about major firms saying, we're not going to renew our office lease anymore because we figured out that our employees can work from home. And retailers, a lot of them filing bankruptcy. We knew retailers were in trouble to begin with, and this has just accelerated that in terms of the number of retailers that are going to go out of business. So I used to think, you know what? I think of all the real estate categories out there, I would probably want to invest in the commercial real estate category that has the least amount of risk associated with it. Because back in the great financial crisis, hospital REITs, medical office REITs did really well. They haven't done well this time because hospitals had to basically close their door except for emergency cases under orders of the federal government because of social distancing. Now they'll probably reopen fairly quickly. So maybe that's not as risky as office REITs and retail REITs. Self-storage has done quite well. So I don't know. I don't know the answer there. I've tried to do some reading in that area to try to judge the risk. I think if you were really an expert in REITs, and there's a lot of academic research about REITs, about how to maybe pick out, there's like 140 publicly traded REITs, so it's not that many REITs out there, and some of them are in specific sectors. But there is some academic research out there that you should, for example, for retail REITs, retail office space, you can go into the quarterly reports of the REITs and look who they are leasing to. And then you can look at the strength of those retailers. And by doing that analysis, you can figure out which REIT is more exposed to risk. That's a lot of analysis, and I don't have time to do that. But I'm sure that analysis could pay off. Then again, maybe a lot of people are doing that analysis and it's already reflected in the prices of REITs if we think the market is sufficient enough. I don't know. So that's a tough question to answer. I don't know how efficient the REITs are in terms of market efficiency for that whole sector. That's an area that I'd like to explore a little bit more. Good question.
Under normal circumstances, air quotes, then it would make sense to purchase it. But since retail is kind of in a mass extinction, it might not ever recover to where it was previously reaching.
Yeah, I think somebody could easily say, well, I'm going to purchase REITs, but maybe I'll purchase self-storage REITs and healthcare REITs and maybe a couple of other types of REITs like timber REITs are out there that don't have the exposure to these large macroeconomic forces out there that seem to be headed towards retail space. Yeah. All right. That's a good observation. Um, not something I'd expect for you to do on an exam, though. Okay. So I'm going to record. This has been recorded. I am going to stop recording it, upload this to YouTube. I would encourage you to watch the morning session as well. A lot of what we covered here, I covered there, but I probably said things a little bit differently. Could give you some ideas. Maybe there's a few things I said there that are different. Certainly the charts were different, and that might help you out as you prepare for the exam. And as always, you can email me, call me, or text me, just not after 7 or 8 o'clock at night, please, because I like to get my hibernation in as a bear. Okay. Thank you all.
Thank you, Dr. Rhoades.